Hi, everyone. Good evening. It's Sean with Paycheck to Portfolio. Wanted to do a quick portfolio update, and then we're going to talk about how I would start with 10,000, my Paycheck to Portfolio plan. Oftentimes I get asked, how can I get started? How can I scale into your system? And so we're going to talk about that in detail here in just a few minutes. Currently, my net account value is sitting at $127,908. My total unrealized gain is sitting at $35,312. The market's been up and down this week, as I'm sure everybody's been following. So I was down $1,000 today. If you're new to my channel, all of my W-2 income rolls into the brokerage. I don't use a traditional bank account. I buy long-term growth assets and or dividend paying assets with those funds. Eventually, what's going to happen over time is my dividends are going to grow, which I can show you here under the estimated income tab. You can see currently my estimated income sitting at $41,319. With every dividend, which you can see under here, these are the different dividend paying assets I get. Some are paid weekly, some are paid monthly. I'm going to show that on an Excel file here in just a second. Basically, what it does is it takes the last payments. You can see the purple is announced dividends, the orange is unannounced, so we're waiting for those. But when it's annualized, currently I'm sitting at $41,319. So what's going to happen is over time, my dividends will snowball and cover all of my living expenses and allow me to live free from a 9 to 5 job. If you look at my performance, let's do a quick update there. And like I said, we'll jump in. My 1 year cumulative performance is sitting at 51%. What that basically means is how well my portfolio is growing, and this takes into account dividends I've received. So you can see again, 51%. The S&P is at 12, the Nasdaq's at basically 13, the Dow's at 11.5, and the Russell's at 5% there. If you look at the 2 year performance, just briefly, I'm sitting at 65%. You can see the S&P is basically at 40, the Nasdaq's at 47, the Dow's at 29, and the Russell's at 17. 3 year performance, I'm basically at 90%. You can see the S&P is 61, the Nasdaq 78, the Dow's 42, and the Russell's basically 28% there. So the portfolio is outperforming the indexes. I'm getting long-term appreciation on the portfolio. I'm getting cash flow, and essentially I'll get freedom from a 9 to 5 job eventually, and I'm aiming for 5 to 10 years. So let's jump right into how I would start with 10,000. So I have a few Excel files here just for simplicity and walking through this step by step. So basically starting left to right, I have the stock in column A. I would start with an S&P 500 growth stock that appreciates and grows in value. So I have SPYG here, which tracks the S&P 500, 1500 there. CLM and CRF, these are closed-end funds I talk a lot about in prior videos. One of the big benefits of these funds is they drip at NAV for a discount every month. So when you receive the discount or the dividend, it drips at the discounted percentage there. We'll talk about that more in a minute. And then these are covered call ETFs by YieldMax. And so what these funds do is they run the covered call strategy for you. They charge you a fee for that strategy, but they pay a good dividend. So looking at the stocks here from left to right, you can see the amount invested here adds up to $10,000. You can see the shares owned here. You can see the dividend per share total here, and I'm going to show you how you can find that on E-Trade. So if you go to the estimated income tab, you can see down here at the bottom, you can type in a symbol here like MSTY. It'll pull up here. It'll automatically go to a quantity of 100, but let's just say you have one, an update. It'll tell you what the last distribution rate was, and it will annualize that for you. You can type 100 in here. It'll do the same thing, and it'll tell you what your estimated monthly income will be for that particular asset. So that's where I'm getting these dividends per share, which add up to $2.84 when you add them all together or sum them up. So the monthly income would be $252 there, basically $253. The annualized income, when you take all those things into consideration, would be $3,032. That's over 30% dividend on a $10,000 investment. You can see I have the NAV discount applied for CLM and CRF. You can see the payment cadence. Some of these are quarterly, some of these are monthly, some of these are weekly. You can see the effective drip yield. I went a little bit more conservative on just for the sake of showing here, and we'll see that in some of the calculations. And then I have notes, one specifically for growth. Two are closed-end funds, both by Cornerstone, which I talk a lot about in prior videos. And then, of course, the Yield Max covered call ETF. So all this you can find on public information. You can go to the Yield Max website. They'll show you their annual distribution. You can go to the Cornerstone website. It'll show you its Drip It Nav feature, which I actually have open right here. So you can click, they update every Friday, and they show you their NAV discount essentially. So there is CRF and there is CLM. And then every year they do a rights offering, and I talk about that again in prior videos if you would like to check that out. So one next thing I would like to talk about is I offer multiple resources, which I'll pin in the comments, from one-on-one calls to our membership program to white glove service. And again, you can look at those under the pinned comments, but we have a calculator in our membership in our Discord. And so lots of times, again, what I'll get asked is, hey, how can I start out? I don't have a huge amount of money, but I want to scale into your system. And so in the calculator, I started out here with $10,000, just like I showed in the first example. I'm starting out with zero margin debt. Let's say I want to pay a car bill or a mortgage or groceries, however you want to break that down, you can put your annual W-2 contribution. So in this case, let's just say we're trying to pay our car bill and it's $7,500 a year. And I know that, depending on what type of car you buy and what your standards are, that may be higher, it may be low. The inflation rate we're going to say is baked in at 4%. That takes account monthly. And you got to pay your car bill or whatever expense you would put here anyway. So we're just going to put a 1-to-1 ratio between contribution and expense. And then we have the drip yield, which I have here. And I've made these a little bit more conservative with current movement. So if you take the drip yield, it's at basically 21.66%. You can see I have that at 21.35 just to be a little bit conservative. And then all the drip on this, and again, this isn't a 1-to-1 ratio, but it shows you some of these covered call ETFs in this calculator that are actually in my portfolio that you can find on the Discord. And on this example, these actually sum up to about 54% blended yields. But again, we use a conservative 32% on the non-drip portion of that. So just want to call that out for transparency. So starting left to right, let's say we start out with a gross portfolio value of 10,000. The drip dividends for CLM, CRF, and GOF on this calculator would be $89, and those would compound and drip at NAV discounts every month. The non-drip dividends that we would take as cash would be here at $134 the first month. We would have zero interest to pay the first month because we haven't taken a margin draw or bridge. So our cash would come straight over to $134. Our monthly expense would be $625. You can see that accounts for inflation dynamically below. And obviously, inflation doesn't necessarily go up like that month after month. But again, it's a conservative calculator. So the first month to bridge that expense, it would be $491 in margin used. We wouldn't pay anything down yet. So we would borrow $491 from our margin account. Our W-2 contribution would come in at $625. And our net portfolio value would show here. So what's going to happen over time is when you scroll down, this will accumulate and compound on itself. And let's say you didn't change anything. After 5 years, now the stock market's not linear. It's going to go up over time, but it won't go up linearly over like this month after month. But you get the point, right? This is showing the power of compounding. So after 5 years, you're looking at $72,846, okay? $648 of drip dividends, $973 of non-drip, okay? And if you come over here to the right, you see when you would break free of this payment where you see zero. And what that means is your non-drip dividends have surpassed your monthly expenses in this example, and then it starts to pay down the margin. Now, the truth is is that I'm just going to buy more cash flow with that margin and arbitrage the cash flow and buy more with it, just like a business would with an SBA loan. But at the end of the day, at the end of the 5 years, basically, you would have a net of 56,404. Now, if you look at my specific situation, where I type in my real-time balances, and we'll wrap up here in just a second. Just want to show you this so you can see it. If you go to my balances, just briefly, you'll see my gross account value, including my cash secured puts, is at 257,283. You can see that my margin balance is sitting right here at 123,362. My net account value is $127,908. So that's what I own in equity. If I sold everything, that's what I would have and walk away from, just like a house, how much I own free and clear. And I always keep my equity above 50%, okay, which you can see right here. I always keep at least 50% equity in my account, okay? You might hear some people say that that's risky, or you're going to hear a lot about NAV erosion in the comments. I've touched on that in prior videos. I would say when you go get a loan on a house and you put 3% down or 5% down or 10% down, and the bank owns 90%, 95%, or 97% equity of your home, I would say this is way more conservative than a home purchase. And I also keep put options on at all times. So if you look at my specific, and let me make sure I'm on the right tab here. If you look at my specific inputs, you can see I've added all those things here. If you go to my 60-month fire plan, and I won't go left to right like I did, you guys kind of get the point already. If you scroll down on mine at month 37 is when my non-drip dividends will cover all of my living expenses, and basically I'm free from a 9-to-5 job, okay? And so really there's three engines that work for you in this system. You have drip dividends that compound and drip at NAV, as I've talked about. You have non-drip dividends that you take as cash payments, just like a rental home would. And then the biggest engine is your W-2 contributions that you would spend to zero in most cases, but now you're investing the whole amount. You're using a margin bridge, and you're owning all of that. So at the end of 5 years, that's $660,000 in my case. My net at the end of the day is going to be $1.3 million basically. But as you can see, $660,000 of that comes from my own income. One last thing I want to touch on when I say the stock market's not linear, I think everybody knows that. But I want to show you my historical value just to show over time it goes up. Obviously, the journey is not linear. So in 1 year, my account value has grown $28,000, and it's going to look more like this, up and down movement, but over time growth. And so I live out of my account. I'm spending out of my account. Funds are being deducted. My mortgage is pulled out. All my bills come out of this account. But through the investments, I'm getting capital gain, appreciation. I'm getting cash flow, and ultimately I'm building financial freedom. And I protect the downside with put options in case the market goes down. So I hope you found this video helpful. Please like and subscribe if you did. Hope you guys have a great weekend. Talk to you soon. Bye.